So, what better place to start than by asking, what is technical analysis? So, technical analysis is the study of past market data in order to predict future prices. This is a very general definition, and whether we're using charts, whether we're using indicators, the same thing applies. We're using previous market data, that is what happened to the price in the past, and we're going to use that in order to predict future prices. Technical analysis stands in contrast to fundamental analysis. Fundamental analysis will study the underlying fundamentals of a security to find its true value. So in the case of a stock, fundamental analysis would be looking at the earnings of a company, and based on the expected future earnings would decide what is the stock value. With technical analysis, we're not really concerned with the value of the stock. What we're more concerned is with the direction of the stock. So we're really interested in which way the stock will go, let's say over the next month or 2 months, rather than what is the value of the company. So this is one of the main differences between fundamental and technical analysis. They're just two different approaches. They use different factors, and they aim to find different things. Obviously, in the end, both are aiming to make money, but the method of analysis is very different. And we'll talk a little bit later on about the differences between the two and when one is better and when the other is better. And of course, as we know, as we've talked about, one of the defining features of technical analysis is that it uses charts as a visual tool, and it also uses numerical tools like indicators. Does it work? One of the many questions people have of technical analysis is whether it actually works. And the fact is that there is a lot of conflicting evidence as to whether technical analysis works. And many people say that it doesn't work and that it is a waste of time. Now, the answer to this question is slightly complicated because it really depends on the situation. There are plenty of investors who swear by fundamental analysis and never really incorporate technical analysis in their decision making because they don't necessarily feel it is relevant. Now, this kind of approach is normally okay for long-term investing. The reason is that most people, nearly everyone believes that in the long term, the prices of stocks and other assets are determined by fundamentals. But when it comes to the short term and medium term, this is not the case. In the short term and the medium term, the value of a stock or any security can vary considerably from its fundamental value. We can have large deviations from fundamental value due to various market conditions. So, what technical analysis aims to do, as we'll talk a little bit about later on, is to understand price movements primarily in the short term and medium term. We can use technical analysis for the long term as well, though it is less commonly done. It's more commonly used for short term and medium term investing. And in general, what studies in other investors have seen is that the shorter the time frame, the more useful technical analysis tends to be. So the answer to the question, does it work? The answer is yes, it does work, and it works primarily in short to medium term time frames. So when we talk about the limitations of technical analysis later on, we'll see where it doesn't work. But it's certainly not the case that it is a waste of time. I mean, if it was a waste of time, we wouldn't be here learning about it. So technical analysis certainly does work, but it works in certain situations, and we need to know what these situations are. The relevance of fundamentals. Now, as I mentioned before, there are some investors, a lot of investors who do long-term investing, who tend to not incorporate any technical analysis into their decision making. Now, if we look at things the other way, it's not necessarily the same. People who use technical analysis don't necessarily believe that fundamentals are not important. In fact, it is generally accepted that fundamentals are quite important in driving the price. And as we know, they do determine prices in the long run. So even someone who uses technical analysis regularly still believes that fundamentals are responsible for driving the price in the long run. So as we mentioned in the previous slide, we'll talk about this in a bit more detail now. In the short term, prices do deviate from fundamental values. We know this because even when we do fundamental analysis, we can see stock prices move quite far away from what we feel they're truly worth. So because of this deviation, if we're trying to predict prices in the short term to medium term, fundamental analysis will not work very well, right? Because in the short term and medium term, the true value is not necessarily going to be equal to the current value. The fundamental value will have nothing to do with the current value, maybe. So how do we forecast prices? How do we predict prices in the short term and medium term? Well, what we need to then do is use technical analysis. So technical analysis is usually better than fundamental analysis when it comes to predicting prices in the short and medium term. Because fundamental analysis is not so useful for that, we use technical analysis to fill this gap. And the other way we can use technical analysis, even if we're doing longer term investing, is to predict timing. So if we want to predict our entry points into a market or our exit points, so entry and exit are essentially short-term phenomenon. We're looking at, say, within a certain period, when should we enter or exit, even if that entry is for a long-term position, we can use technical analysis to help us there. So technical analysis, essentially, we use it to fill the gaps that fundamental analysis cannot help us with. It's about probabilities. Whenever we use technical analysis, we need to think in terms of probabilities. Okay? Now, think about it this way, right? Whenever we have an indicator telling us to buy or sell, let's assume an indicator tells us we need to buy. It doesn't mean that the price will necessarily go up after that indicator tells us to buy. Sometimes that indicator will be wrong. Sometimes the price will actually go down, and we should have sold, not bought. Now, this doesn't mean it's a bad indicator. What we need to do is adjust our mindset in the following way. Whenever an indicator tells us that a stock price will go up, what that indicator is really saying is that there is a greater than 50% probability that the stock price will rise. So sometimes it will be wrong. Sometimes the stock price will actually fall. But if our indicator is good, it will be correct more often than it is wrong. So this is really what technical analysis is about. We need to find indicators that have a higher than 50% probability of being correct. So if an indicator, let's say for example, is correct 2/3 of the time, if we make many trades using that indicator or strategy, then over the long run we will be profitable, even if some trades will go wrong. And that's the most important part about technical analysis. We need to think in terms of probability. We need to think every time we make a trade, there is an X probability that it will be successful and a 1 minus X probability that it will be a failure. And we're hoping that the probability that it will be successful is greater than 50%. Now, much of technical analysis boils down to finding the right indicator given our situation. And that's something we will discuss in much greater depth when we go through the technical trading systems module about how to find the right indicator and how to create a trading strategy. But for now, let's just remember this, that we need to think in terms of probability whenever we do technical analysis. Two approaches. There are two primary approaches to technical analysis. And we alluded to this a little bit earlier when we were discussing the course structure. If you remember, our second module was chart patterns and analysis, and our third module was technical indicators. And this is really about understanding the two different approaches to technical analysis. The first approach relies on charts. In this case, what we tend to do is use technical analysis as a visual tool. We will look at charts, and based on what we see in the charts, we will use that to predict the future price. The second approach relies more on indicators and statistical analysis. And what we're doing here is actually calculating indicators that are based on the past prices, and we're using statistical analysis to make decisions. So we're looking at what is the volatility of the asset, what is the likelihood of going up or down given various situations, and this form is more numerical and will be Excel based as we go through this course. Now, historically, if we look at technical analysis, the evolution of the field over time, charting was the primary form of technical analysis. And charting is a little easier. We'll talk a little bit in a bit more detail about what these are, how these work. And today, due to the rise in computing power, using indicators and statistical analysis has become more common. Because what we find is that indicators and statistical analysis require many calculations and many mathematical calculations, which, unless we have good computers, we can't necessarily do. So this is why previously people used charts more often, and today a lot more people use indicators and statistical analysis. And of course, we will be learning about both of these approaches during this course. Now let's go through in a bit more detail each of these approaches. So the first approach, charting. As we mentioned, when most people think of technical analysis, they think of looking at charts. When we look at charts, we look for particular visual patterns in those charts and make predictions based on these. So, for example, one of the most well-known chart patterns is the head and shoulders pattern. The head and shoulders pattern refers to the shape made by a particular price series. And whenever we see this shape in the price, we can use that to make a prediction on future prices. And chart patterns, there are many other different patterns out there. And we also have trend patterns, we have support patterns, we have resistance patterns. So we'll draw many lines, for example, on the graph. And when we do this, we're essentially looking to find these common patterns and use those common patterns to make predictions about the future price. The advantage of charting is that it is normally easier to do. All it requires is you to have a chart and you to have a price where you can plot that chart. And then we can look into it, do our analysis, and go from there. Now, one of the key distinguishing features of charting is that it is a very discretionary method. And that's actually one of its disadvantages. What I mean by discretionary is that there is a lot of individual leeway in decision making. So we'll see when we compare with indicators, indicators are very clear-cut. They tend to be, if X occurs, then buy, otherwise sell. With chart patterns, it's not the case. It's not as clear, simply because the patterns that we see are often not that clear. We may see something that looks like a head and shoulders pattern, but it may not turn out to be one, or it may be something a little bit different. So because of this discretionary element, it is often difficult to test how well it actually works. So this is one of charting's disadvantage, and also one of the reasons people move towards more numerically based methods in recent years. Indicators and statistical analysis. The second method, and the more newer method of technical analysis, is to use indicators and statistics. For example, we can calculate a moving average of a price, as we discussed before, and we can use this to make predictions about future prices. So why is this method very useful, and why has it become more dominant than charting over time? The reason is that it's much easier to test the effectiveness of different technical trading strategies. If we have a moving average strategy, we can test it over a past series of data. This is known as backtesting, and we'll go through this in a lot of detail in the technical trading systems module. We can test the effectiveness of different strategies, and this makes it easier to find which strategies are profitable and which ones are not. And the other thing we can do with indicators is that they can also be used on charts. So we can also plot moving averages on a chart, just like we can put them in Excel. Now, charts sometimes are visually more appealing. They're often easier to see, easier to visualize what's going on, but it's not necessarily the best way to analyze how effective a strategy is. It doesn't necessarily allow us to do backtesting, and this is why we use indicators in a numerical form, and we do a lot of statistical analysis as well. Now, when we use this form of technical analysis, we can be discretionary or automated. So what is an automated system? An automated system is one that takes out human decision making from the equation. So what we would do is create a strategy, let's say a moving average strategy, that says when the price crosses the moving average from below, we buy; when it crosses it from above, we sell. We would have a rule, for example, a technical trading rule, and we would automatically buy and sell whenever this rule was hit. Okay, and that's what an automated strategy is. And when we go into technical trading systems, we will talk about the advantages and disadvantages of discretionary versus automated systems. But of course, this type of analysis is used heavily to build trading systems, and it will be a large focus of this course. A holy grail. Now, it is very important to make this one qualifying statement before we carry on further. And I am pretty sure that all of you are aware of this. Most of you, I'm sure. But I still need to say it anyway because it's just very important. Technical analysis is not a holy grail to uncover the secret of the markets. And I'll repeat this, it is not a holy grail to uncover the secrets of the markets. There is no magic indicator, there is no surefire way to beat the market every time. If someone comes to you and tries to sell you a technical trading system that they guarantee will earn you large profits, it is a load of crap. Okay? You should turn around and ask them, well, if it's guaranteed to earn me profits, why are you selling it and not using it to get rich yourself? The simple fact is that there is no guaranteed way to beat the markets with any technical indicator or any technical trading system. Now, this of course does not mean that technical trading systems do not work. All it means is that there is no one system that works all the time. What we will find is that with technical trading systems, we need to consistently adapt those systems. Because market conditions change over time, we need to change our strategies and adapt our systems to those changing market conditions. And this is why we don't really have this holy grail. And we'll talk a little bit about this more in the upcoming slides. But for now, let's just get this clear and get this ingrained in our systems that there is no magic indicator and there is no holy grail to technical analysis. And as we alluded to earlier, evolving markets. Evolving markets are one of the primary reasons why There is no holy grail to technical analysis. So let's think about this more systematically. Why is it that if someone sells me a technical trading system, why will it not work consistently? The reason is that markets are constantly evolving. Markets change. Market conditions change. The underlying fundamentals of the market change. And price behavior changes. And because of this, there is no holy grail, right? So if we have an indicator or a technical trading strategy that worked well in the previous year, it may not work well this year. A strategy that works well for one stock may not work for another stock. A strategy that worked yesterday or the day before may not work today. The simple fact is that because markets are always changing and always evolving, we will never find a trading system to consistently beat the market. It is just not possible. Now that does not mean that we cannot still beat the markets over time. All it means is that we need to have trading systems that are adaptable, that change. We need to update our strategy regularly. We need to pay attention to the fundamentals and pay attention to changing market conditions. We need to incorporate various different forms of analysis in order to be successful with our technical analysis. So when we're thinking about strategies, if a strategy is working on a stock, we need to bear in mind that it may not work later on. We need to constantly monitor how it's doing, and if we find that later on it's actually not working, we need to change it.